We now move to the question of capital expenditure modelling within our investment appraisal DCF model we've been building. Capital expenditure are payments that are made to improve the capital value of a property. They are cash flows because there's cash basically coming out of the owner's pockets. They are not an expenditure, which is part of the profit and loss process, a detraction against your profit. But from a cash flow point of view, they're simply considered as cash going out. They're treated a little bit differently for taxation, because unlike an expense which is deductible from income tax, the capital expenditures are not tax deductible. However, what can happen is that some capital expenditures, in fact this is what we're going to consider for these ones, are able to be depreciated over their useful lives. And so if you consider something like maybe carpets through a building, and they might have a 10-year life expectancy or something, when they're purchased, the capital expenditure, the cash which is paid for them, is simply paid. However, the tax deduction comes over the next 10 years as depreciation. And so if you spend, let's say, $10,000 on carpets, you can't claim the tax deduction immediately as a $10,000 deduction. What you have to do is take that as a depreciation expense over $1,000 per year for the next 10 years. From a finance point of view, that's a little bit less efficient, because the 10th year, the last $1,000, the dollars are going to be worth less than the dollars that you've spent actually putting the carpets in today. And so there's a preference for expenses over capital expenditure and depreciation. We're going to be looking at the question of depreciation separately. For our purposes here, we simply want to look at how do we put in these periodic payments every 5 years, every 10 years, what have you. Capital expenditure, by definition, a capital item, is something which is going to have a life expectancy of more than a year. And so it's going to be this undefined recurrence interval. For our model, what we're going to do is assume that it's going to be something that's going to happen regularly every 5 years, every 10 years, every 12.5 years, whatever it is going to be. How do we model that? When we look at the modeling, this slide basically outlines what we're aiming to do. We're going to be aiming to squirt into our model at regular intervals the capital expenditure amount, which is going to be given in a particular data input location. The data input is going to be the amount of the capital expenditure. Here we're calling it depreciable inclusions because eventually we're going to depreciate it. You can read that, or if you can even label, if you like, as regular capital expenditure or capital expenditure, whatever you like. But for these regular capital expenditures, we'll take the amount and we'll look at their economic life. The function that we're going to use to distribute them into the body of the DCF is going to be an if statement. And here we're going to be looking at writing the if statement basically at two levels. I'm going to demonstrate it. You'll notice that there's details here in the presentation. Let's go to our model now and put our capital expenditure in. Depreciable inclusions, as I say, we can call this capital expenditure if we like. We'll stay here with the $9,000. I'm going to turn this from 10 down to 2, merely because it will give us a bit more interest. We'll be able to see some things happening with our short little DCF here. At 10 years, it simply doesn't feature on our model at present. However, when you write your own models and you write them out for your 10, 20 years or what have you, then these longer economic lives will start to produce some interesting results on your model. The capital expenditure row, it goes in as row 31. What kind of an equation are we going to write here? Well, what we need to do is, now this is really a mathematics question rather than an Excel question. Excel, the functions you can look into yourselves. The conditional statements have to do with things like equals or greater than or less than. And then we can look at the functions. Now, the mathematical question is, how do I work out when I'm in a year which is an even multiple of the economic life? If I express the question in those terms, it becomes a little bit more obvious. Even multiples do not have remainders when you divide them. And so what I'm going to do is divide the year that I'm in by the economic life, and if it has a fraction part, in other words, if it's not an integer, I'm going to say, well, I'm not replacing the depreciable inclusion at that point. However, if I have no remainder, it means it's an even multiple, and that's the time when the capital expenditure is paid for. Let's look at writing that expression now. It's an if statement, so we write if, open brackets. Now the logical test is if my year divided by the economic life as an absolute is equal to the integer of the same expression close brackets. Okay, so if the year I'm in divided by the number of years of economic life basically is an integer, comma, then I will import the cost of the depreciable inclusions, the capital expenditure. I'm going to absolute that, otherwise it will be 0, and close brackets, hit enter, and if that behaves itself, what I should have now is the $9,000 being inserted here every second year. If I change my recurrence interval there into every 3 years, you'll see now it's coming in on years 3 and 6. If I take it to 4, it now only comes in year 4, and so on. So I've basically done that. Now let's go back to an economic life of 3 years. I have a problem because I now have the cash flow grabbing this capital expenditure at a point where I don't have the property anymore. Year 6, remember we only had year 6 in order to be able to work out the EBIT for the purpose of estimating the notional sale. How do I switch this off? Well, I could write this equation from scratch, but what I'm going to do is basically wrap another if statement around this one. It's called a nested if statement, because this expression could be just simply one of the expressions, the value, if you like, of one of the options in the if statement. And so here the test is similar to what I've done earlier, where I've said what I want to do is get 0 if the year I'm in here is greater than the numbers of years owned, and I'll absolute that, comma. So if the year I'm in is greater than the numbers of years owned, then I'm going to have 0 come back. Otherwise, I'll have this other if statement. And now to finish off my equation, I have to close out my brackets, so my brackets are nicely balanced. And so now I have a very long and perhaps ugly looking expression that is 2 if statements, one inside the other, these nested if statements. And so doing this nested if statements enables us to achieve quite complex logical tests. Let's accept that, and we will fill that back, and now that has taken out the second $9,000. Let's change our economic life here to 2 years, so we've got a few more 9,000s coming in, and I'm going to change my years owned down to 3 years. And you'll notice with a 3-year length of ownership, I don't own the property in year 4, and so the 4th, 5th and 6th cash flows have gone. And so what that's telling us is that our equation here is actually working. It's giving these two conditionals to give us the capital expenditure at the right time. That's as far as we need to go now with this. If you don't want to write these complex if statements, that's fine. For the purposes of our analysis, it's not very difficult to simply write these in manually. However, it's not quite as elegant as having them automated, and that's one of the reasons why we're doing this extension activity.